This is Golden Years, a roadmap to navigate retirement with Mark Cordner, the podcast.
So take a look at your next retirement account statement there. Can you really tell me what you're paying in fees? They can show up really in different places. They can say something like advisor fees, fund expenses, commissions, and a lot of it just quietly comes out of your account. You probably don't even know it. You certainly maybe never feel it. So what's a simple way to help get a handle on this? Well, here's Jason Kephart with Morningstar.
So you really want to keep in some rules of thumb, like your all-in costs. Like if you have $100,000, what did you actually pay in fees that year? Whether it's commission, fee-based, or fee only. And what is your total cost? We think the average in the industry is probably around 1%. That's what gets bandied around a lot. So if your fees are significantly north of that, I would maybe ask some more questions. And if they're significantly under that, maybe you're getting a good deal, or maybe there are some services you're not being offered that, others might be.
So interesting here. So what did you think about his suggestions here? I mean, how should somebody really evaluate the fees that they're paying? And then also at the end of the day, if my fee says it's 2%, as a normal everyday person, I go, okay, I guess it's 2%. I mean, what do I know the difference?
Yeah, that's a great point. And, this is absolutely on people's minds. I always want to bring it up in our first discussions because I know it's lurking in the back of their mind. We do these complimentary consultations, and in the back of their mind, they're always thinking, okay, what's the catch? When's the other shoe going to fall? That kind of thing. It's always in the back of the mind. It should be. And so we need to bring it up because it's not a question really about cost so much as it is value. I mean, certainly costs are important, but costs are always relative to something, We always got to ask, compared to what? And so a 1% fee, yes, is often average, but, there are some products out there that'll charge fees of 3 to 4% a year, and people do those. They accept those products because they have unique bells and whistles or different features, and so it's really a question of what are you getting for your value. I've had this conversation really recently. I mean, I'm thinking the last couple of weeks, there were two big accounts that came to us, one from the radio show, one from our public seminars, and these individuals' fees were, frankly, 2 and 3 times what we charge. And the ironic thing is they weren't getting anything for it other than quote-unquote money management, just someone choosing where to put their investments and hopefully monitoring them to some degree. But we laid out this whole series of services that we provide, like the tax considerations with Roth Consulting, healthcare management, home equity management, all sorts of, income planning, all these different services that we provide as part of our fee, and here we were half to a third of what these other people were charging and not getting any of those services. And so it's not a question of what's right or what's wrong. It's a question of what does the client need, what is the client's expectations. And my experience is most people don't have a clue what they're paying, particularly in their 401k plans. The Wall Street Journal did a study some years ago that said that the average 401k is paying around 3% in fees. So that was a surprise. I think it was like 3.5 actually. This has been some years ago, about a decade ago. But the bottom line is they're paying a lot more than they realize. So it's not just the investment management fees, but there are fees at the product level for the mutual fund or exchange traded fund that you may be using, whatever kind of investment you're using. There's also trading costs. The more actively the portfolio is being managed, there's often trading going on that, frankly, in many cases is unnecessary, but it's just generating fees for Wall Street. So all those things add up, and not all of those things have to be disclosed to the client. So I'd love it when people bring up this topic because, a good advisor is never going to shy away from hard questions. We're going to welcome those questions because people need to know, what are you getting for what you're paying? There needs to, if I'm not providing value, there's no reason for people to work with me. And so, yeah, let's have those conversations. We invite that.
Mm-hmm.
So, yeah, as folks come in to talk to us, please ask the question. If you beat us to the topic before we get there, great. All the better. Let's talk.
Yeah, I think it's definitely part of that open conversation, and even doing something as simple as a fee analysis for folks that don't have any idea of what fees they're paying, how much, when, where, all these things, and what the value is they may or may not be getting out of it. If you're interested and want to know exactly how much money you're paying for those fees and that you want to sit down with a fee analysis, we'll do that for you, especially when you come in for that discovery visit with Mark one-on-one, 702-996-4050. 702-996-4050. That website, of course, mygoldenyearsroadmap.com. This is interesting. Wendy's apparently, they're going through a rough patch. Earnings are down, the market share is slipping, and the stock has taken a hit. So apparently they are rolling out a new chicken sandwich. They are rolling all the dice here, hoping it's going to turn things around. And that is a lot riding on just one menu item, no matter how great it is, right? But I wonder if you see something similar with people when it comes to nearing retirement. Maybe they start looking at their savings, they feel a little behind, and now they think, all right, let's roll all the dice, let's take one more big risk and hope I can come up with some last-minute winnings to close that gap. First of all, have you seen this before? And then second of all, Mark, is this usually a success or does it backfire?
That's a great question. It's a loaded question because it can go any different direction. But absolutely, yeah, we see that behavior. Some people, particularly men, testosterone fuel, think that, I'm just going to roll the dice, as it were. I'm not quite where I wanted to be, and so we're going to amp up the aggressive portions of the portfolio. I've got a couple coming in later today that are actually going to be, they've been so accustomed to looking for greatest rates of return that we've got to have a conversation about scaling that back, because they're at an age, as they go into their early 70s, where really we don't have time to recover. And that's the biggest issue, is time. It's time and timing. And so when we properly diversify a portfolio, there's something very interesting that happens. It's very counterintuitive, but when we diversify appropriately, which is as broad as possible, typically what that means is we're going to reduce the volatility in the portfolio and also increase the returns. There's been some really wonderful academic studies that show this. Now, again, it's all about doing it properly, covering all known asset classes, for example. But bottom line is time and timing. When the bad news hits, can be devastating if we're taking withdrawals from an investment portfolio at the same time. It's what we call sequence of return risk. We can't control which years are going to be positive or negative in the market. The other thing we can't control is how long it's going to take to recover. I mean, if you lose 50% of a portfolio in a big hit, like we had some people experience in 2008, they've got to earn 8% a year for 9 years just to get back to where they were when they started. You lose 30%, it's going to take you about 5 years to get back. And those kind of losses have happened to people. So time and timing are what we really can't play around with. And some people do kind of throw the dice, to use your terms there, as they get close to retirement. And that's, in my opinion, the exact opposite thing of what they should be doing. We need to be thinking more preventively about how do we keep what we've spent all these decades accumulating. So if people don't know what kind of risk they have in their portfolio, and rarely do they, come visit with us. Let us do a portfolio analysis for you. Not only do we find often that people are paying too much for the wrong type of assets, but they're also far more aggressively positioned than they thought they were. And so as we enter retirement, that's usually not when we want to amp up the volatility in a portfolio. And that's what many people do. And they get over-concentrated and they get spanked by the market. So don't put yourself at risk. Come let us do an analysis with you.
Yeah, that portfolio analysis, guys, is a great place to start, because also think about this. Just because you're throwing the dice, right, more risk, it doesn't mean that you're going to have a better income. I mean, when I say throwing the dice, guys, there's a 50-50 chance that you're going to either close that gap or wipe that gap completely out along with your money. So you need to make sure that, you're going to make it worse. You need to make sure that you're making those right decisions. This portfolio analysis is a great place to start. That phone number again, 702-996-4050. 702-996-4050. And again, that website, mygoldenyearsroadmap.com. Well, inflation is still running above the Fed's target of 2%, but the market may have already priced that in. Here's investment officer Sebastian Page on CNBC.
In March, at the end of March, we thought the year-over-year earnings growth for the S&P 500 was going to be 13%. We're running at 27%. So here's what we're doing. We're taking some profits on the broadening trade, but importantly, we're hedging inflation risk. My dentist always asks me for investment advice. I don't know why, but I always keep it short. I always say stay invested, stay diversified. It's trite, right? But what I'm telling my dentist now is stay invested, stay diversified, hedge inflation risk.
All right, so when you hear the words hedge inflation, Mark, what does that actually look like inside a retirement plan?
Well, it looks different for different people. I mean, really what we're talking about is beating inflation so that our money's not devalued. I mean, I remember buying candy bars for 10 cents when I was a kid, and I was in a convenience store traveling last weekend, and it was $2.69 for the same candy bar. I was dumbfounded. And so that's what we're talking about, is the fact that money becomes increasingly less valuable over time due to inflation. And so we need to have our portfolio positioned in a way where we can outpace inflation. Historically, it's been about 3%, but many of us feel like we got a plan for ahead of that. But again, bottom line is we need to be invested in the market. That's typically the best place to go to get ahead of inflation trends. And he says diversify. I would say take it one step further and rebalance, because many people try to diversify, and there's different ways to do that. We need to be very broadly diversified, but we absolutely have to rebalance, because what also happens during aggressive periods like we're seeing this year is that portfolios get out of balance, they get out of whack, they get over-concentrated in those hot sectors of the portfolio, and then before we know it, things cool down, and that sector takes a beating because we weren't regularly going back in and rebalancing to the original risk tolerance that the client really should be putting up with. So, yeah, stay invested, stay diversified, and rebalance.
When you talk about rebalance, I instantly just had a scale in my mind. You know, you got one side and the other side. You're trying to make everything balance. I mean, is that, I know it's kind of a common sense term here, rebalance, but is that essentially what you're doing? You're moving this over there, you're moving this over here to find that balance and also manage that risk?
Yeah, what you're doing is actually counterintuitive. It goes against human nature, because when one sector of your portfolio is doing really well, the human nature is you want to keep pushing money into that sector because you think it's always going to go up. But the reality is eventually it will go down. And so really what we're talking about is selling good performing sectors of your portfolio and rebalancing, meaning diversifying back to what your original model called for. If you don't do that, before you know it, you're so lopsided. You've got 50, 60, 70 or more % of your portfolio all in this aggressive sector that really will spank you when things turn around, because things always do turn. So rebalancing is just going in on a regular basis, at least annually. Many people do it quarterly, but your advisor should be doing this automatically as part of your service. Most do-it-yourselfers don't do this. They don't even think about it. They're not even aware of the risk for the most part, but it absolutely is critical, especially in retirement, because remember, retirement is far more about risk management than it is getting the sexiest rates of return possible. And we've got to get people disabused of this idea that it's all about rates of return. I literally had someone this last weekend email me asking me what their portfolio is going to look like in 5 years. And really, he was just trying to talk about rates of return. And that's important, but it's not the most important consideration in retirement. So, yes, be invested in the market, diversify, and rebalance. Rebalance is really about protecting your assets. So come visit with us, folks. You know, if these are new ideas to you, we absolutely can help you. Let's analyze your portfolio, see where you're at, see if you're over-concentrated in the wrong areas, and let's get a healthy portfolio that can sustain not only against inflation, but against the other downturns in the market that could also spank you. Come visit with us. We can help you with all these issues.
Investment advisory services offered through Golden Years Financial LLC, a registered investment advisory firm. Insurance is offered through Golden Years Insurance Services. These firms do not provide legal or tax advice. Consult your own legal and tax advisors before taking actions that may have tax implications. Investing in securities involves risk, including the potential loss of principal. Insurance contracts principal protection is based on the claim-paying ability of the respective insurer. None of the information contained on this website shall constitute an offer to sell or solicit to buy a security or insurance product. The information and opinions contained on this site or requested from this site are provided by third parties believed to be reliable, but accuracy and completeness cannot be guaranteed. They are provided for informational purposes only and are not a solicitation to buy or sell any of the products mentioned. Any media logos and or trademarks contained herein are the property of their respective owners, and no endorsement by those owners of Mark Cordner, Golden Years Financial, or Golden Years Insurance is stated or implied.